Reducing slippage in algorithmic trading involves several strategies and practices to ensure trades are executed at the desired prices. First, improving algorithm efficiency is crucial. This can be achieved by optimizing execution algorithms such as VWAP, volume-weighted average price, TWAP, time-weighted average price, and implementation shortfall algorithms, which help minimize market impact. Additionally, reducing latency by optimizing code, using faster hardware, and placing servers closer to the exchange can significantly enhance trading performance. The choice of order types and sizes also plays a vital role in reducing slippage. Using limit orders instead of market orders allows traders to control the execution price. Breaking down large orders into smaller ones, a technique known as order slicing, can prevent significant market movements. Employing iceberg orders can conceal the full size of trades, thereby avoiding adverse market reactions to large visible orders. Liquidity management is another essential aspect. Trading in high liquidity assets ensures ample buyers and sellers, while accessing multiple liquidity providers can offer the best possible prices. Timing the market is also important. Traders should avoid periods of low liquidity, such as early in the trading session or during lunch hours, and monitor market conditions to steer clear of high volatility periods unless they have strategies specifically designed for such environments. Regular transaction cost analysis helps in understanding and mitigating slippage. Continuous analysis and adjustment of strategies based on observed slippage, along with thorough backtesting and simulation under various market conditions, can refine trading approaches. Selecting the right broker and exchange is also critical. Brokers known for low latency and high-quality order execution should be preferred, and using co-located servers at exchanges can reduce trade execution times. Lastly, effective risk management practices, such as implementing pre-trade risk checks and using dynamic order adjustment algorithms, help ensure that orders stay within acceptable limits and adapt to real-time market conditions. By adopting these comprehensive strategies, traders can minimize slippage and enhance the overall performance of their algorithmic trading systems.